Thank you for joining today's R Street Insurance Forum on the private market for flood insurance. I'm Jerry Theodorou, Director of the R Street Finance, Insurance, and Trade Program. With me today are Caroline Melear, a fellow in the R Street Finance, Insurance, and Trade Program, and our special guest, Trevor Burgess, President and CEO of Neptune Flood Insurance. Our program is 30 minutes. I'll say some introductory words. Caroline will have a few remarks, and the bulk of our program will be given over to Q&A with Trevor, and there will be time for questions coming from you using the question feature at the bottom right of your screens. Since its founding 10 years ago, R Street has engaged on public policy issues that relate to flood. R Street helped to draft the 2012 Biggert Waters Act. We've argued unrelentingly for the need for a robust private market for flood insurance, for NFIP rates to reflect risk magnitude, for effective ways to deal with repetitive loss properties, and for increased penetration. In the United States, only approximately 14% of homeowners carry flood insurance. By contrast, in the UK, it's about 95%. And there in the UK, coverage for flood losses is included in their standard homeowners policies. So there is a way. R Street continues to engage on matters related to flood insurance. About a month ago, I testified to the US Senate Banking, Housing, and Urban Affairs Committee on reauthorization of the National Flood Insurance Program, the NFIP. In our written testimony at that hearing, which is freely available in the committee website and on the R Street website, the number one recommendation out of 5 recommendations that we made for reform of the NFIP was for the need for the private market to develop. And a few weeks prior to that Senate hearing, the House Financial Services Committee, the subcommittee relating to insurance, held a hearing on the NFIP as well. Caroline, you covered that event for R Street. There were 5 experts that were testifying at that hearing. Did you hear anything or read anything in the testimonies of the experts that had to do with the private market?
Hey, Jerry, thanks for having me on this webinar today. Yes, so I covered the subcommittee on housing, community development, and insurance hearing on NFIP. It's one of a few NFIP hearings I have covered in the past few months. And a couple of the expert witnesses were really interested in speaking about the private market for flood insurance. Franklin Nutter, he is the president of the Reinsurance Association of America, and Karen McHugh, she is the Missouri State NFIP coordinator, and she also was representing the Association of State Floodplain Managers. Both of their testimonies, their verbal as well as their written, which goes very extensively into the private market, we're really focused on ways to broaden the market, ways to incorporate private flood insurance. And, something interesting that maybe people don't necessarily know is NFIP was never designed to pay for catastrophic events. The concept really was risk sharing with the private sector. It was really kind of like a insurer of last resort. And so even into like the late 1980s, that was kind of the consideration through which NFIP was supposed to be, kind of a backstop of last resort for homeowners. And that shift really over the past few decades has been really rapid to where the private market for flood has been kind of priced out with the artificial rate caps and controls. With flood being the most prevalent, most expensive form of natural disaster across the United States, we've got to open it up to private insurers, get more of that involvement. And in my view, my read at least, is the legislators on these committees, they want this to happen. They want more private market participation. It's just a matter of how do you get there? The FEMA director has certainly been very open that he wants more private market participation. So there's room for this to happen. It's just a matter of how do we get there?
Yeah, thanks. And thanks also for picking up on that history there, which a lot of people don't know. As you say, the NFIP was founded in 1968, and in its first 10 years of existence, before it moved out of HUD and into FEMA, there was participation by the private flood. So it has been done. It can be done. So now let's get to meet our special guest, Trevor Burgess. Would you like to introduce yourself a little bit and Neptune Flood Insurance, Trevor? And thank you for joining us, by the way. We really appreciate it.
Very happy to be here to talk about flood insurance and private flood insurance in particular. I'm sorry that we only have a half an hour because I could easily spend 3 or 4 days talking about private flood. The audience would be asleep by then, but I'd be great. Neptune was founded with the idea that it didn't have to be so hard to buy flood insurance. Part of the challenge with the NFIP today is that it takes an agent 20, 30, 40 minutes to answer all of the questions to be able to get a rate and present that rate to the consumer. We thought, could we build an engine, use cloud computing technology, artificial intelligence? Could we build an engine that was so powerful that we would be able to analyze the risk of an individual home, decide whether or not it was one we were able to offer insurance on, and price that risk in less than a second? And the answer is yes. So in 2018, we began selling policies. And today, 4.5 years later, we have about 125,000 clients. That makes us the largest private flood insurer in the United States. But yet, we still only have about 2% of the NFIP market share. So we're still small, growing very quickly. We add about 1,000 clients a day. And the only reason that we can do that is because of that technology investment we've made. Different ways of looking at risk. We look at hundreds of different data elements, not the FEMA maps, but individual things. What is it about that particular piece of land or that structure that makes it particularly susceptible to flooding? And the great part about private flood today, and I'm a former bank CEO, so I'm used to how regulation of flood insurance happens in this country, a lot through banks, because the basic law is if you have a mortgage and you're in a high-risk flood zone, then you're required to have flood insurance. And banks are used to regulate that. So I've got a good sense that people are super, super interested in protecting themselves from this peril. Sometimes because it's mandatory, but sometimes because they just know that it's something that should be a part of the underlying policy. So Neptune, actually today, over 50% of our sales are outside of those high-risk zones.
Great, no, thanks. That's very impressive. Congratulations on that trajectory. Now let's pivot a little bit from the technology, which is central to your value proposition, to the coverage itself. The NFIP policies have sometimes been critiqued for being rigid. $250,000 limit for homeowners, $500,000 for a business. Do private market policies differ in the wording, in the policy language, in the coverage that's offered from the NFIP? Can you talk a little bit about the coverage that's there, that's available?
So the underlying rule really coming out of bigger waters was that private insurers, to be accepted by banks, needed to provide the same basic coverage that is provided by the NFIP form. So we actually use the NFIP form as a starting point of our policy. And we just can't erode coverages or make it worse, and so we don't. But we can make it better. So we offer 5 optional coverages that are very, very popular with consumers. Those are things such as temporary living expense cover. If you're flooded out of your home and need to stay in a hotel, give you some money to help pay for that. Things like basement contents, replacement contents, unattached structures, things to cover your pool. None of those things are included in that base NFIP form, but we're able to offer these optional coverages and make it a more robust policy that is more consumer friendly. That's number one. As for values, the average home in America today is way more than $250,000. So it's not enough to replace even the average home. We go up to $4 million in coverage on homes and businesses. So we can offer a much more protective layer of insurance. And if you look at our entire portfolio today, that 125,000, 65%, would not qualify for the NFIP today because they have bought an optional coverage or have selected higher limits. So we actually see that the marketplace is demanding something that private can provide, which is a more robust policy with more protection.
Right. In the insurance world, one of the ways of being creative for insurance companies is to have the sublimited areas of coverage where you've got 10,000 for this, 20,000 for that, adding those bells and whistles. So you've certainly done that. Now, what about at the lower end? You talked about the maximum 4 million people that live in mobile homes or condos that are smaller. Is some form of flood insurance available for those kinds of customers in the private market?
Yeah, I'm not aware of any private insurers that cover mobile homes, and Neptune does not. The risk models that we've built do not allow us yet to analyze those kind of risks, although it's something that we're working on. We do have a very large number of condominium buildings, and we allow people to buy very low levels of coverage, down to $25,000 or $50,000 of coverage. If you live in a condominium, your building may have insurance, but that's only covers to the drywall. Your contents, your interior elements, those are your responsibility. And very often people don't think about that risk. We do a lot of education trying to get people who are in condominium units to actually buy coverage, especially if they're in riskier zones.
Great. Now let's talk a little bit about the NFIP. At the hearing where I presented last month, and also in a hearing that happened the following week, later in June, where the director of the NFIP testified, one of the topics that was talked about quite a lot, especially by the ranking member, Senator Pat Toomey of Pennsylvania, was repetitive loss properties. There's about 2% of the NFIP policies that are generating close to half of the losses because they've had 2, 3, 4, sometimes even more than 10 losses. And the right signals have not been given for remediation and for prevention of those kinds of repetitive losses. Now, do you or other private market insurers have policies or ways of dealing with repetitive loss properties, customers that have had flood losses? Do you accept them? Do you just not offer them a quotation? How do you deal with properties that have had historical losses?
So there are definitely some places in the United States where houses should not be built today, either because of climate change or because of actually long-standing areas that are just really, really risky and probably should never have had a house built. The way that Neptune approaches it is we ask the customer the question, have you had a loss before? If they've had one small loss, we'll accept the policy. If they've had 2 or more losses, or it was a very large initial loss, then it's something that we don't insure. And some of that is because we're not the government. You're aware that the FEMA has a program where for some of these repetitive loss properties, they can buy out the house in part so that it does not cost more. I mean, you've read the stories about some $100,000 houses where they paid out $500,000 in claims. It would be much cheaper to help that person relocate. The government has the power to do things like that, and obviously private insurers don't. So there are some kinds of policies that really need government's involvement for more holistic solutions. But it is a real challenge for the NFIP in the long term to make money if they're going to keep insuring those repetitive loss properties. Prices are going to have to go up, which they are.
Right. And prevention, we know the adage, an ounce of prevention is something that insurance companies do with their loss control departments. They send out loss control engineers to survey properties, sort of pre-quotation, pre-binding, and they make recommendations and they offer the insurance. The companies will offer the insurance subject to. Do you have that sort of approach as well, where you have measures that can mitigate losses and allowing those to be covered where without the fulfillment of the recommendations, they would not be? So subject to, where you have these inspector reports.
Unfortunately, our analysis shows that micro level adjustments, micro level changes that one might make to their house can have very small impact. But if you want to have a large impact, you need to do things like build new levees or very large government infrastructure projects, like have been done in the Netherlands or in the UK, or that we've done in New Orleans and are working on in places like Charleston and Houston. So there are, I'm very much, our data shows that those sorts of large infrastructure projects can have a meaningful impact on the risk profile. But if you have a house that was built at sea level and there's regular flooding at sea level, unless you're going to be jacking up that house 4, 5, 6, 7, 8 feet, which is extremely cost prohibitive to do, there's not a lot you can do. There's not a magic fix that can then really fundamentally change the risk at that property. And because we're trying to make it easier for people to buy flood insurance, because we have this view that we want to get to that sort of UK level of penetration in the United States of people at risk, we need to sort of do this very quick processing that does not allow that sort of individual consultative role. Now, there are companies that do that, and it may be impactful one by one, but as a public policy measure, our data and our analysis of the science shows that the only thing that really would make an impact would be those major multi-billion-dollar government investments.
Yeah, I'm glad you mentioned that, Trevor. That reminds me, you mentioned the Netherlands or Holland, which is one of the low countries. Why is it called one of the low countries? Because most of the country, if not all the country, is below sea level. And the Netherlands has struggled and suffered from flooding events for hundreds of years until in the mid-1950s, after a massive flood there caused substantial destruction, they said basta, in whatever that is in Dutch. And they undertook a program of building levees and firewalls and these other kinds of mega infrastructural projects that you mentioned. And since 1955, which, this is 70 years ago, there's only been once when there has been flooding in the Netherlands, in one of the low countries below sea level. So they actually did that. And here in the United States, now we have enough political issues with attempted infrastructure programs, and we have the state by state structure as well. So it doesn't look as if we're going to do anything a la Holland soon, but that is indeed something that people should know about, that it has been done, it can be done, and we need not throw our hands in the air. Now, one thing, Trevor, that you keep coming back to is the numbers. And here, just like to throw out some numbers. There's about 5 million policies that the NFIP has, 5 million policies. And you mentioned that you're the largest on the private market with currently 125,000 or so. There's about 70 million single family homes in the United States. So my napkin math suggests that the market for flood can increase tenfold to go from 5 million to 50 million, which is still a lot less than 70 million, which is less than the 95% which you recognized for the UK. So do you think that's really what the goal is, to really have a massive increase in penetration, that we can go from 5 million to 20, 30, 40, 50 million or more? Because it is such a risk, and not just in the flood zones, as we know.
So if we look at the science and look at where flooding has actually a reasonable enough probability of happening that it makes financial sense for someone to buy a flood insurance policy, you're looking at about half of the buildings in the United States. So half of the American households, there are about 100 million total buildings. You're talking 55 million buildings in the United States should have flood insurance. So we're talking that today we have about 10% penetration of those that should have flood insurance. So we think that there's a lot of room to grow. What's exciting about Neptune's evolution over the past 4.5 years is that when we started out, it was very much like the NFIP, focused on those mandatory zones, those A and V zones that are coastal, right next to rivers, clearly high risk, but not a ton of focus on the X zones, or what some people erroneously call not in a flood zone. We have focused and tried to adjust pricing and our sales approach to be able to make ourselves attractive to those X zone properties that are at risk. And in the past month, over 60% of our sales were in X zones. So we are successfully going beyond the remit of the NFIP and successfully beginning to eat into that larger universe of consumers who really need the product but have never been focused on because they weren't part of that mandatory program.
And what else could be done to spread the word, to increase knowledge and awareness of flood risk? I think education, you're implying that education is part of it. If the agents appreciate the simplicity and having access to different markets, what measures do you think can be pursued in the next few years to get this really moving up more rapidly than it is currently? Because we do have such such exposure, and you look at the way the NFIP has performed. So what can be done, do you think, to ramp up the penetration?
What's interesting is that the mandatory elements if you think about it, they're really great at protecting an individual homeowner, but they're also a great risk management tool for the banks that make the loans. Because without that insurance in place, they would be all but certain to have very large losses in case of a large event. So if you think about things like our regulatory structure when it comes to banks, are banks really looking at the risk management, their risk management profile appropriately? Right? Banks all require everybody to buy homeowners insurance, whether it's a federal government mandate or not, because it's reinsured by the federal government. But even if it's a portfolio loan for a bank, every single one has to have flood insurance. We need to think as a financial services community about, are we really approaching risk management the right way if banks are not requiring their borrowers to buy this really important coverage? As Caroline mentioned, this is the most frequent and most costly peril. So why would banks leave it out? Just because the government says you don't have to do it? I mean, that's a real long-term competitive disadvantage. You will have outsized losses if you don't think about this differently. So I think that we as an industry need to do a better job at educating banks about the risks, sharing data with banks about how, if you have something that's an X zone in Houston, Texas, it's actually pretty high. You should require someone to have flood insurance. There are things that banks should do to help protect themselves, which will also protect consumers.
Right. Yeah. Let's turn for a second to the capacity providers, the insurers and the reinsurers that bear the risk. Is it the same sort of cast of characters, the excess and surplus lines carriers that engage in these kinds of risks and other kinds of tough risks? Or is it a growing market where you've got some of the standard lines insurers getting involved? Is there growing involvement from reinsurers in Europe and Lloyd's? Or yeah, can you give us a sense of the landscape? You don't have to name names of the insurers and the reinsurers that are bearing the risk of the policyholders. Expanding, same?
It's definitely expanding. We've been able to grow, quite rapidly with the support of the global insurance community. Lloyd's, big participant in that, but also some domestic insurers, but not necessarily the traditional standard homeowners carriers. And the main reason for that is they have already all the wind risk. So doubling down and taking the wind and the flood risk at the same time is very, very difficult. And there's too much cross correlation at this time. Eventually, as the models get better and they're able to charge appropriately for it and manage their reinsurance in such a way that they have the proper, caps in place, maybe they start to come online, but we haven't seen it yet. Have not seen any mainline US homeowners insurance companies say, I'm also going to take the flood risk while I'm taking the wind. Hasn't happened yet. It may in the future, but I think we need more robust history of private flood insurance, more robust testing of the models that private insurers use to get to the point where they're comfortable with that. Because the biggest example so far is the NFIP, which, as you know, has $37 billion of lifetime losses.
Yeah. Right, and where you mentioned the need for improvement of the models and the data, I would add that to the extent that models are improved and made more credible and more robust, that would attract the third-party capital in the form of ILS, the insurance-linked securities, where they need the data. You can have a parametric trigger for inches of rainfall or something, and you can have capacity coming there if you're not getting it from the traditional market. Actually, we have a question that came in, Trevor, when you mentioned repetitive loss properties. You talked about a substantial loss. Do you have a definition of substantial?
Yeah. So we use $25,000 as the bar for determining the what a substantial loss is. That's enough money where it's not just something nuanced or one-off. We're really looking only to exclude those really terribly risky properties where only the federal government has the resources to actually do something about them.
Yeah.
We could, to be clear, we could set the price for insurance, but it would be prohibitive for a consumer to buy it. And that's probably a really interesting thought, right? I know what the price should be for that repetitive loss property, but it's in the high tens of thousands of dollars. It could be $60,000, $70,000 a year to actuarially accurately price that risk for that home. That's not something that the American homeowner can afford to do, but it tells you about how risky that property is that the government today is insuring, which is why buyouts, other solutions really need to be thought of as part of the long-term picture of, quite frankly, saving the government money.
Let's talk a little bit about distribution channel and how your policies get out there. You mentioned agents, so you deal with a lot of retail agents. Do you also have connection to the wholesalers that typically feed the surplus lines market, or is it are you agnostic as to distribution source, how the business comes to Neptune?
I started out by talking about how we really view ourselves as a technology company, a software company that's built really slick software that makes it easy to buy flood insurance. So we're trying to get that into as many people's hands as possible. That's through agents. About 95% of our sales are through one kind of agent or another. That can be a large national homeowners carrier who wants access for their consumers to the private markets, who links up with Neptune. That could be wholesalers who then do a good job of aggregating mom and pop agencies across the country. Or it could be direct relationships with potentially sophisticated or particularly sophisticated mom and pops who come directly to Neptune for access. And we're able to handle all of those. In the first half of this year, over 8,000 agents across the country bound a policy with Neptune. And that's up about double from last year. So we're excited about the growing reach and knowledge of private flood insurance amongst the agent community.
Great.
We also make our product available directly online. And that has been of growing popularity where consumers can have direct access to the product.
Great. Now we're coming up against the half hour. We got time for one more question. I'll throw out one more question that came in. And it is, as the private market develops, it seems likely that the lower risk properties would be attracted to the product. Is it correct that the NFIP may well be overpricing these policies and will be disintermediated by the private insurers? If so, the end result is that the average risk profile would increase at the NFIP. Is that right? Yeah, that goes back to a theme that I think about in terms of cherry picking. If the private market cherry picks policies that are overpriced by the NFIP. Any thoughts on that, Trevor, before we close?
Yeah, two quick thoughts. One, risk rating 2.0, the NFIP's new rating methodology, seeks to address their underpricing that they know that they've done for a long time. It'll be a 10-year ramp of prices to get to the point where 95% of their policies are priced in an actuarially accurate way. But at that point, they will be priced actuarially accurate, and there should not be a competitive advantage or disadvantage to the NFIP versus the private market. The second thing I'd say is that the NFIP policy is no longer necessarily appropriate for a lot of especially high value homes. If you need more than $250,000 of coverage, you need to go to the private market. That may be a very high risk property that we're then taking on, but people are willing to pay for that coverage well above what the NFIP would charge. They're willing to pay for that coverage for that very risky policy because they need $1 million or $2 million of coverage.
Great. Thank you for that. And thank you for joining us today, Trevor. We really appreciated that. And it certainly made me feel more optimistic. There are many voices out there that are doubters that the private market really can't get involved in this risk, but you've shown that you're doing it, and there's a lot of potential for others to do it as well. So on that hopeful note, I'm going to thank you. Thank you, Caroline, for joining us. And thank you to all of the people that joined us today on our Street's Insurance Forum on the private market for flood insurance. If there are more questions, my email is on the R Street website. So is Caroline's. Send them our way, and we'll try our best to point you to some good insights. So thank you, and enjoy the rest of your week.